The Illusion of Wealth, John's story. John had always believed that owning a home was the ultimate sign of success. Growing up, he heard the same advice from his parents, teachers, and even financial experts on TV. Buy a house as soon as you can. It's the best investment you'll ever make. So as soon as John landed a stable job, he did exactly that. He saved every dollar he could for a down payment, signed a 30-year mortgage, and proudly became a homeowner at the age of 28. It felt like a dream come true. But as the years passed, that dream started to feel more like a burden. The mortgage payments were just the beginning. There were property taxes, repairs, maintenance costs, and unexpected expenses that kept piling up. Every time he thought he was getting ahead financially, something else needed fixing. A leaking roof, a broken water heater, a new tax increase. John's friends, who had chosen to rent instead of buy, seemed to have more freedom. They traveled, invested in new opportunities, and built businesses. Meanwhile, John was stuck, pouring most of his income into a house that wasn't giving anything back except a place to live. One evening, John came across an article about how the wealthy think differently about home ownership. It challenged everything he had been taught. Instead of rushing to buy a house, many of the world's richest people focused on building assets that generated income, not just liabilities that drained their finances. For the first time, John questioned the belief he had held for so long. Was homeownership truly the smartest financial move? Or had he fallen into a trap, one that kept people feeling successful while secretly limiting their financial freedom? That night, John started researching, eager to understand what the wealthy knew that he didn't. What he discovered would change the way he looked at money forever. The truth about homeownership: is it really the best investment? For many people, buying a house is seen as the ultimate financial goal. It represents stability, success, and security. From a young age, we're told that owning a home is one of the smartest financial moves we can make. Parents encourage their children to buy property as soon as possible, believing it's the key to long-term wealth. But what if this belief is flawed? What if the wealthy, the people who truly understand how to build and maintain financial freedom, see homeownership differently? The homeownership myth. Is your house really an investment? For decades, the idea of owning a home has been sold as the ultimate financial achievement. Parents encourage their children to buy property as soon as possible. Financial advisors preach the benefits of home ownership, and society as a whole views it as a milestone of stability and success. But what if everything you've been told about home ownership is only half the truth? Many people believe that buying a house is the safest and smartest investment they can make. The logic seems simple. Real estate values increase over time, so owning a home should lead to long-term financial growth. However, a house is not an investment in the way most people think. Here's why. Unlike stocks, businesses, or rental properties, a primary residence doesn't generate income. Instead, it requires constant expenses, mortgage payments, property taxes, maintenance, and unexpected repairs. While homeowners might celebrate when their property value increases, they often overlook the hidden costs that eat away at those gains. Consider this. If you buy a home for $300,000 and sell it years later for $500,000, it might seem like you made a $200,000 profit. But after factoring in mortgage interest, property taxes, maintenance, and inflation, the real profit is often much lower than expected, or even non-existent. Meanwhile, truly wealthy individuals approach real estate differently. Instead of buying homes to live in, they focus on acquiring assets that generate income, rental properties, commercial real estate, or other investments that put money into their pockets rather than taking it out. So does this mean owning a home is always a bad idea? Not necessarily. But it does mean that blindly accepting homeownership as the best financial move can be a mistake. The key is understanding the true nature of your purchase. Is it a strategic investment, or is it simply an emotional decision masked as a financial one? Before making one of the biggest financial commitments of your life, ask yourself, are you buying an asset that builds wealth or a liability that keeps you trapped? Is your home a hidden financial trap? For generations, people have been taught that buying a home is the ultimate financial milestone, It's seen as a symbol of stability, success, and even smart investing. But what if that belief is misleading? Robert Kiyosaki, the author of Rich Dad, Poor Dad, challenges this idea. He argues that a home is not an asset, it's a liability. Why? Because instead of making you money, it takes money out of your pocket every single month. At first glance, homeownership seems like a great financial move. But look closer, and you'll see the hidden costs that many homeowners overlook. Mortgage payments are just the beginning. You also have to pay property taxes, insurance, maintenance, repairs, and unexpected expenses that add up over time. Unlike rental properties or stocks, which generate income, your primary residence does not put money in your pocket. Instead, it continuously requires spending. Many people assume that rising property values will make up for these costs. But real estate markets are unpredictable. Plus, when you factor in inflation, interest payments, and ongoing maintenance, the profits from selling a home might not be as high as you expect. Think about it. If you buy a house for $400,000 and its value increases to $600,000 in 10 years, that sounds like a $200,000 gain. But after paying for mortgage interest, taxes, repairs, and upgrades over the years, how much of that money do you really keep? Meanwhile, truly wealthy individuals take a different approach. They focus on acquiring assets that generate income, like rental properties, businesses, and investments that pay them every month. Instead of being trapped in a cycle of expenses, they build wealth by making their money work for them. This doesn't mean buying a home is always a mistake, but blindly believing that your house is an investment can be dangerous. The key is understanding the difference between an asset and a liability, and making financial decisions based on long-term wealth-building strategies, not just traditional advice. So before making one of the biggest purchases of your life, ask yourself, are you buying an asset that makes you richer or a liability that keeps you stuck? The hidden cost of homeownership, what the wealthy do differently. Most people believe that buying a home is the smartest financial move they can make. They save for years, put down a large payment, and commit to a mortgage that will take decades to pay off. But the wealthy see things differently. Instead of tying up their money in a house, they focus on something far more valuable: cash flow. This concept comes down to opportunity cost, a principle that most people overlook. When you put $100,000 into a home down payment, that money is locked away. It's not generating income. It's not working for you. Sure, your home might appreciate in value, but in the meantime, you're still paying for property taxes, maintenance, and mortgage interest. It's an expense, not an income-generating asset. The wealthy understand this. Instead of sinking their capital into a home, they invest in cash-flowing assets, businesses, stocks, and rental properties that generate income every month. These investments don't just sit there. They grow over time while providing financial freedom. Imagine two people. One buys a house with a $100,000 down payment, while the other invests that same amount into dividend stocks and rental properties. The homeowner now has a mortgage, bills, and maintenance costs. The investor, on the other hand, earns passive income that covers their rent while their assets appreciate. Over time, who do you think builds wealth faster? This doesn't mean buying a home is always a bad decision, but it does mean you should think critically before assuming it's the best use of your money. The question isn't just, can I afford this house? It's, what else could I do with this money to create real financial freedom? Wealth isn't about owning expensive things. It's about owning assets that pay you. The wealthy prioritize cash flow over status, and that's why they continue to grow richer while the average person stays financially stuck. So before making the biggest purchase of your life, ask yourself, are you putting your money to work or are you just spending it? The hidden trap of homeownership. Why the wealthy value liquidity. For many, buying a home represents security and financial stability. It's seen as the ultimate investment, one that will appreciate over time and build wealth. But there's a hidden downside that most people don't consider: illiquidity. Unlike stocks, bonds, or even rental properties that generate cash flow, a home is one of the least liquid assets you can own. If you ever need cash quickly, Whether for an emergency, a new investment opportunity, or even a major life change, selling a home is not easy. It can take months to find a buyer, and the costs involved, agent fees, closing costs, repairs, can eat away at your profits. This is why the wealthy think differently. They prioritize liquid investments, assets that provide flexibility and quick access to cash. Instead of tying up their capital in a house, they put their money into stocks, businesses, and real estate that generate income. This liquidity allows them to seize new opportunities when they arise, whether it's investing in a high-growth company, expanding a business, or purchasing undervalued assets during a market downturn. Imagine two people. One puts all their savings into a house, while the other invests in liquid, income-producing assets. Years later, a once-in-a-lifetime business opportunity comes up, but only the second person has the cash to act. The homeowner, on the other hand, is stuck. Their wealth is tied up in an asset they can't quickly sell without significant costs. Owning a home is not inherently bad, but understanding its limitations is crucial. If all your money is locked in a property, you risk missing out on better opportunities for wealth building. The wealthy don't just accumulate assets, they ensure their assets provide both cash flow and flexibility. Before you commit to homeownership, ask yourself, are you investing for financial freedom, or are you tying up your wealth in something that limits your options? The hidden costs of homeownership: interest and depreciation. For many, buying a home is seen as a smart financial move, an investment that will appreciate over time. But what most homeowners fail to realize is the true cost of homeownership, particularly when it comes to interest payments and depreciation. The interest trap. A home sticker price is rarely what you actually pay. Let's say you buy a $300,000 home with a 30-year mortgage at a 6% interest rate. On paper, it seems like a reasonable purchase. However, by the time you finish paying off the mortgage, you will have spent over $640,000, more than double the original price. The reason? Compound interest works against you. While banks promote homeownership as a wealth-building strategy, they profit enormously from long-term mortgage payments. The longer the loan term, the more money they make, and the more you lose. The myth of guaranteed appreciation. Real estate agents often emphasize that home values always go up, but that's not entirely true. While some properties appreciate, others stagnate or even decline, especially in areas with economic downturns, population shifts, rising property taxes. Even if your home's value does increase, depreciation is unavoidable. Unlike stocks or rental properties that generate passive income, a home requires constant upkeep, roof repairs, plumbing issues, remodeling costs. Over time, these expenses can add up to tens or even hundreds of thousands of dollars, eating into any potential profits. The wealthy think differently. The wealthy understand that a home is not a guaranteed asset, it's an expense. Instead of locking their money into a mortgage, they focus on investments that generate cash flow, such as stocks, businesses, rental properties. These assets not only appreciate, but also put money into their pockets every month, rather than draining it through interest and maintenance costs. The bottom line: owning a home isn't necessarily a bad decision, but thinking it's a foolproof investment is a mistake. Before committing to a mortgage, it's essential to understand the long-term financial impact and explore whether your money could be working harder elsewhere. Are you truly building wealth or just taking on an expensive liability? What the wealthy do differently. For generations, owning a home has been seen as the ultimate sign of financial success. It's the dream that parents pass down to their children, the belief that if you work hard, save diligently, and buy a house, you'll secure your future. Society reinforces this idea at every turn, from financial advisors to real estate ads promising that homeownership is the smartest investment you can make. But what if that's not entirely true? Take a closer look at how the wealthy handle their money, and a different picture emerges. While many people rush into homeownership, convinced that it's the fastest path to wealth, the financially successful approach their decisions differently. They don't just follow conventional wisdom, they question it. Why do some of the richest individuals choose to rent instead of buy? Why do they invest in assets that generate consistent cash flow instead of tying up their money in a house? Why do they prioritize financial flexibility over the idea of owning property outright? These are not random choices. They are deliberate strategies based on a different understanding of money, one that goes against what most people have been taught. While the average person is focused on owning a home as a milestone, the wealthy see a much bigger picture. So, if the key to financial freedom isn't simply buying a house, then what do the wealthy do instead? Why the wealthy choose to rent instead of buy? For many people, owning a home is considered the ultimate financial achievement, a sign that they have made it. Society reinforces this belief, encouraging individuals to buy as soon as possible with the promise that real estate is the safest investment. But if that's true, why do so many wealthy individuals choose to rent instead? It's not because they can't afford to buy. In fact, they often have the resources to purchase homes outright. Yet, instead of locking up their capital in a property, they opt for financial flexibility. The power of liquidity. Renting allows them to free up cash that would otherwise be tied to mortgage payments, property taxes, maintenance and repairs. Instead of putting hundreds of thousands of dollars into a down payment, they invest that money into income-generating assets, stocks, businesses, and rental properties that provide cash flow and grow in value over time. The hidden costs of homeownership. The wealthy understand that real estate appreciation isn't always guaranteed, and homeownership comes with hidden costs. A home requires constant upkeep and renovations, unexpected repairs, roof leaks, plumbing issues, HVAC replacements, significant expenses that many homeowners overlook. By renting, they avoid these liabilities while keeping their capital liquid and available for high return opportunities. A mindset shift, control over tradition. But this mindset isn't just about numbers. It's about control. The wealthy refuse to let their money sit idle in a single property that doesn't generate income. Instead, they focus on building financial freedom through investments that give them flexibility to relocate or pursue opportunities, passive income streams that grow their wealth, the ability to adapt to market changes. So while most people believe that owning a home is the smartest move, the wealthy take a different approach, one that prioritizes cash flow over status, financial growth over tradition, opportunity over obligation. Why the wealthy focus on cash flowing investments? For most people, buying a home is seen as the safest financial decision, a long-term investment that guarantees stability. But for the wealthy, the strategy is different. Instead of tying up their money in a primary residence that generates no income, they prioritize cash flowing investments, assets that put money in their pockets every month. Imagine two individuals. One purchases a home for $500,000 while the other takes the same amount and invests in rental properties. The first person spends years paying off a mortgage, property taxes, maintenance, and other expenses. Their house may appreciate in value, but until they sell it, it remains a financial burden, not an income source. Meanwhile, the second individual acquires real estate that generates monthly rental income. The tenants pay down the mortgage, and the properties provide consistent cash flow. Over time, as rents increase and property values appreciate, their wealth grows without them having to work for it directly. This is the difference between owning an asset and owning a liability. The wealthy understand that financial success isn't just about what you own, it's about how those assets work for you. A primary residence doesn't produce income, but rental properties, dividend stocks, and businesses do. By focusing on cash flow over home ownership, the wealthy create financial freedom. They're not locked into a single property that drains their savings. Instead, they have multiple income streams that cover their expenses and allow them to reinvest in even more opportunities. So, while many people see homeownership as the ultimate goal, the wealthy see it differently. They don't just buy a house for security, they invest in assets that generate real wealth. How the wealthy use other people's money to build wealth. Most people believe that financial success comes from saving diligently and buying assets with their own money. However, the wealthy understand a different game, one that revolves around leverage. Instead of relying solely on their own capital, they use other people's money, OPM, to acquire assets that generate cash flow and appreciation. Imagine two individuals. One saves for years to buy a house in full, tying up hundreds of thousands of dollars in a single property. The other uses a mortgage or investor funding to acquire multiple rental properties, ensuring the income from tenants covers the loan payments while still generating profit. The second person has created wealth using leverage, while the first has simply locked up their capital in an illiquid asset. The key is using financing strategically. The wealthy don't take on debt just for the sake of spending. They use it to acquire assets that pay for themselves. Whether it's real estate, businesses, or stock investments, they make sure the returns from their leveraged investments exceed the cost of borrowing. Banks, investors, and financial institutions have billions of dollars available for those who know how to use it wisely. The wealthy take advantage of these resources to scale their portfolios faster, while the average person hesitates, believing debt is always bad. But not all debt is created equal. Bad debt funds liabilities, while good debt funds assets that grow wealth. This approach allows the wealthy to multiply their wealth exponentially rather than waiting years to save enough cash to make big purchases. By understanding how to leverage OPM effectively, they turn financial opportunities into long-term wealth-building strategies. Why the wealthy invest in businesses and high-return assets. For many, homeownership is seen as the ultimate financial achievement, a symbol of success and stability. But the wealthy take a different approach. Instead of tying up their capital in a house that doesn't generate income, they invest in businesses and high-return assets that create financial freedom and scalability. Consider this. A person buys a home for $500,000, locking up their savings in a down payment and committing to 30 years of mortgage payments, property taxes, and maintenance costs. While the home may appreciate over time, it does not generate income. In contrast, a wealthy investor might take the same $500,000 and start a business, invest in stocks, or acquire income-generating assets. A well-run business can produce consistent cash flow and unlimited earning potential, something a house cannot. Similarly, investing in stocks, private equity, or venture capital allows for high returns and liquidity, providing flexibility to reinvest in new opportunities as they arise. These strategies give the wealthy the ability to scale their wealth rather than being tied to a single illiquid asset like a house. The key difference is how money is put to work. The average person sees a house as an investment, but the wealthy understand that an investment should generate cash flow and appreciation. Instead of sinking money into a liability, they prioritize assets that grow their wealth exponentially. This mindset shift is what separates the financially successful from those who remain stuck in the cycle of earning, spending, and saving with little long-term growth. The wealthy don't just aim for security, they leverage their capital to create real financial independence. Is buying a home the right financial move for you? For many, homeownership is seen as the ultimate financial milestone, a symbol of success, stability, and security. But is it truly the best financial decision? Or is it simply what society has conditioned us to believe? The truth is, buying a home isn't inherently good or bad. It all depends on your goals, financial situation, and priorities. If your main focus is long-term stability and having a place to call your own, purchasing a home may make sense. The emotional satisfaction of ownership, the ability to customize your space, and the predictability of staying in one location can be valuable. However, if your goal is financial growth and flexibility, tying up your money in a home could limit your ability to build wealth. A house is a major financial commitment, requiring not just a down payment, but also ongoing costs like mortgage payments, property taxes, insurance, and maintenance. These expenses can restrict your ability to invest in higher return assets that could grow your wealth more efficiently. Before making the decision, ask yourself, am I buying a home because it truly aligns with my financial strategy or because I've been told it's the right thing to do? Many people assume that homeownership is the safest path without considering alternative ways to use their money. The wealthy understand that financial success isn't about following conventional wisdom. It's about making informed decisions based on opportunity, flexibility, and return on investment. At the end of the day, buying a home is a personal choice, but it shouldn't be an automatic one. Instead of making an emotional decision, take a step back and evaluate what will truly serve your long-term financial success. Key takeaways. Buying a house is a mistake. The wealthy know this. Owning a home is not the best financial move. A home is a liability, not an asset. It drains money through mortgage, taxes, and maintenance without generating income. Lost investment opportunities. Tying up money in a house prevents investing in higher return assets like businesses, stocks, and rental properties. Lack of flexibility and liquidity. Selling a home takes time and comes with high costs, limiting financial mobility. What the wealthy do instead. Rent and invest the difference. Focus on cash flowing investments like rental properties. Use leverage to buy income-generating assets. Before buying a home, ask yourself, is this truly the best financial decision or just what I've been told to do? Imagine a life where you're not tied down by a massive mortgage. What could you do with that money instead? Travel the world? Invest in high return opportunities? Build your own business? This is why the wealthy think differently. Owning a house isn't always the best financial move. It's a decision that could limit your options and slow down your wealth building journey. Instead of pouring your savings into a single property, consider investments that generate continuous cash flow and provide real financial freedom. Think about this. A house may appreciate over time, but does it truly give you the flexibility and financial security you need? What if you could invest in assets that grow faster and give you passive income? The wealthy focus on making money work for them, not locking it away in a property that costs them more than it earns. Now, it's time to challenge the traditional mindset. Will you follow the crowd, or will you take control of your financial future? What do you think about this perspective? Let's discuss in the comments. If you're ready to unlock more financial secrets, don't forget to like and subscribe now.